Imagine opening an earnings report for a company that just sold like $64.7 million worth of product, right?
Okay.
And then you look down the sheet and you see they posted a net profit of over $800 million.
It's absurd.
It is. It's like, did they discover literal gold under the factory? Did they hack the Federal Reserve?
Right. No, they found a GAAP accounting loophole.
Exactly. And today we are tearing apart the financial reality of the most hyped sector on earth right now. We're talking about quantum computing.
It really is the ultimate financial illusion. I mean, you look at one line item and you think, wow, this is the most profitable enterprise on the planet.
Yeah.
But then you look at another and you realize they are just burning cash like it's going out of style. The paradox there is, it's absolutely fascinating.
It really is. So welcome to another Talk Tickers Deep Dive. Our mission today is to cut through all that Wall Street jargon, bypass the dense quantum physics textbooks, and really break down the highly anticipated Q1 2026 earnings call from IonQ.
Ticker symbol IonQ.
Right, exactly. They are a recognized leader in quantum computing. And look, as a retail investor, you were constantly bombarded with hype around quantum tech.
Oh, constantly.
Every headline promises that quantum will cure diseases, solve climate change, hack your bank account, all before breakfast, basically.
The hype cycle is deafening. I mean, it makes it incredibly difficult to figure out what is a real business with, durable unit economics and what is just an expensive science experiment funded by venture capital.
Which is exactly why we are looking exclusively at the data today. We're going to figure out if IonQ is a legitimate portfolio cornerstone that you should be, holding for the next decade, or if it is just a cash-burning machine dressed up in a lab coat.
A very expensive lab coat.
Very expensive.
Okay.
So here is the Talk Tickers roadmap for this deep dive. We are going to start by looking at the headline numbers, unpacking that bizarre $800 million profit mirage.
We definitely need to explain that one.
Oh, yeah. Then we're going to look at the story behind those numbers, specifically the underlying physics that are actually allowing them to land these massive commercial contracts.
Right.
After that, we will analyze management's future guidance and the looming kind of existential shadow of something called Q-Day. And finally, we will give you the actionable bottom line on whether to hold, fold, or buy.
It is a massive amount of ground to cover, but if you are allocating capital in the 2020s, you simply cannot afford to ignore this transition.
Totally agree. So if you're reading this balance sheet at home, you're probably doing a double take at the top line numbers.
Yeah.
Let's start right there. In the first quarter of 2026, IonQ delivered $64.7 million in GAAP revenue.
Right.
Now, on its own, $64 million might not sound like much for a publicly traded company. But context is everything here.
Context is absolutely everything, because that $64.7 million represents a staggering 755% year-over-year growth.
Which is just wild.
It is. That is more than 8 times the revenue they delivered in the exact same period last year. And not only that, they beat their own internal revenue guidance by over 30%.
Which is almost unheard of. I mean, even in the hyper-growth software sector during the 2010s boom, you rarely saw a company beat their own top-end guidance by 30%.
Very rarely.
And on top of that, the company is sitting on just a massive financial fortress. They have $3.1 billion in cash equivalents, and short-term investments just sitting on the balance sheet.
Yeah. If you are an investor, those are the kinds of numbers that make you sit up and pay attention immediately.
Definitely.
But to really understand what is happening under the hood, we have to look past the top-line revenue and dig into a metric that the chief financial officer highlighted extensively, and that is RPOs.
Okay, so I'm looking at this RPO number, remaining performance obligations,
right.
And coming from the traditional SaaS world, software as a service, I usually read this as backlog. It's like money that is contracted but not yet recognized on the income statement. But quantum hardware isn't a simple, $20 a month software subscription. Does that standard SaaS definition still hold up here, or are we looking at something fundamentally different?
Well, the underlying concept is the same, but the mechanics of how it actually gets realized are very different and, frankly, much more complex.
Okay, how so?
So RPO stands for remaining performance obligations. In plain English, it is guaranteed future money. When IonQ signs a massive multi-year, multi-million-dollar contract with a national government or a Fortune 500 enterprise, they cannot just slap all that revenue onto their quarterly report on day one.
Right, because of accounting rules.
Exactly. Yeah. Accounting rules, specifically ASC 606, dictate that revenue must be recognized as the performance obligations are actually met.
Right, because delivering a quantum computer isn't like sending a download link. There are massive physical milestones.
Oh, absolutely. There is site preparation, hardware delivery, installation, the incredibly delicate process of calibration, which takes forever. And finally, customer acceptance testing.
Wow.
Revenue is recognized in tranches as those milestones are hit over months or even years. But the total value of that legally binding contract, the money that is locked in but hasn't hit the income statement yet, sits in that RPO bucket.
So it is essentially a high-fidelity measure of the sales team's current momentum.
Precisely. And IonQ's RPOs hit $475.6 million this quarter.
Unbelievable.
That is up 554% year over year. To give you some context on how powerful that momentum is, the CFO noted a specific ratio.
What was it?
For every $1 of revenue IonQ recognized and put on the books this quarter, they added $2.50 to their RPO backlog.
Oh, okay. So they are selling the future significantly faster than they are physically capable of delivering the present.
That is the exact dynamic you want to see in a company that is essentially creating a brand new market category out of thin air.
Right.
It means the sales team is out there hunting whales, you know?
Yeah.
They're locking in massive sovereign wealth funds and enterprise giants, creating this huge pipeline of future cash flow.
Which is exactly what you want as an investor.
It gives investors incredible forward visibility. If you know a company has nearly $500 million in guaranteed future revenue, it takes a massive amount of the risk out of the equation for the next few quarters. You aren't guessing if they can sell the product, you just need to know if they can actually build it.
Which brings us back to the financial illusion we started the show with. We have a company recognizing $64.7 million in revenue.
Right.
Yet I am looking right at the GAAP net income line on the transcript, and it says they generated a positive $805.4 million in profit for the quarter.
Yeah.
How does a company with $64 million in revenue generate over $800 million in profit? I mean, it defies basic arithmetic.
It really looks like a typo, doesn't it? But it is a non-cash accounting quirk, and honestly, it is a trap for retail investors who don't read the footnotes.
A huge trap.
You have to look at the specific line items below the operating income. The vast majority of that net income, about $1.1 billion of it, actually comes from what is recorded as a, quote, mark-to-market warrant valuation.
Okay, we need to completely unpack this.
Yeah.
Because mark-to-market warrant valuation sounds like the kind of dense, impenetrable jargon Wall Street uses to intentionally confuse retail investors.
Oh, totally.
Let's break down exactly what a warrant is in this context and why it is generating $1 billion phantom profit.
So, to understand this, you have to remember how IonQ went public. They went public via a SPAC, a special purpose acquisition company, a few years ago.
Right, back during the SPAC boom.
Exactly. And during those SPAC transactions, companies often issue warrants to early investors to sweeten the deal. A warrant is essentially a financial derivative. It gives the holder the right, but not the obligation, to buy a share of IonQ stock at a specific, predetermined price in the future.
So it's very similar to a stock option.
Very similar. Now, here is where the accounting gets weird. Because the company is legally obligated to issue new shares if those warrants are ever exercised, GAAP accounting rules require the company to classify those warrants on their balance sheet as a liability.
That makes sense. It's a potential future dilution, right? A claim on the company's equity.
Right. But the rules also require the company to mark to market the value of that liability every single quarter based on the company's current stock price using complex pricing models like the Black-Scholes model.
Okay, I see where this is going.
Now, think about the math here. If IonQ's stock price goes down during a given quarter, the value of those warrants, the right to buy the stock at a certain price, also goes down. Therefore, the total value of the company's liability decreases.
And in the bizarre, upside-down world of GAAP accounting, a decrease in a liability is recorded as a gain on the income statement.
Exactly. IonQ stock price experienced some volatility and trended downward over this specific quarter.
Yeah.
Because the stock price dropped, the calculated value of their warrant liability plummeted. The accounting rules forced them to record that massive drop in liability as a paper gain, making it look like they pulled $1.1 billion in profit out of thin air to offset their operating losses.
Wow.
And that resulted in the $805 million net income figure.
So because their stock price fluctuated, the algorithms and the accounting rules forced them to print a massive paper profit.
Yes.
It has absolutely zero to do with their actual day-to-day operations. I mean, they didn't sell 800 million worth of quantum computers. They didn't collect 800 million in cash from customers. It is pure paper volatility.
It is entirely disconnected from the business reality. And, it cuts both ways.
What do you mean?
If the stock price skyrockets next quarter, that liability will increase, and they will have to record a massive billion-dollar paper loss on their income statement, even if their core business is executing flawlessly.
Oh, that's wild.
This is what we call Schrodinger's balance sheet. Until you strip away the derivatives and observe the actual operating cash flow, the company is simultaneously wildly profitable and heavily bleeding cash.
That's a great way to put it. So what does this all mean for the person holding this stock in their brokerage account? If you're holding IonQ, you cannot be fooled by that 805 million net income headline.
Do not fall for it.
If you see an algorithmic news article praising their massive profitability, or like a stock screener highlighting their incredibly low price-to-earnings ratio, you need to ignore it. It is noise.
Absolute noise.
So if the net income's a phantom number, what is the actual ground truth number we should be looking at to judge their operating performance?
You have to strip away the GAAP accounting quirks and look at the adjusted EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. While it's not a perfect metric, in this case, it is a much cleaner look at the cash actually being generated or burned by the day-to-day operations of the business.
Because it strips out that warrant valuation nonsense.
Exactly. And when you look at IonQ's adjusted EBITDA for the first quarter, it was a loss of $96.8 million.
Okay, so reality sets in. They brought in $64.7 million in revenue, but they burned almost $100 million in operating costs.
Yes. Although the CFO was quick to point out that about $12 million of that EBITDA loss was a highly specific one-time R&D expense.
Oh, what was that for?
It was related to their commercial fabrication agreement with a company called Skywater, which we will definitely discuss later.
Got it.
But if you strip that one-time non-recurring expense out, the normalized operating burn was closer to $85 million for the quarter.
Okay, so we have roughly 64 million in revenue coming in.
Right.
And they are burning 85 million to 96 million on the operating side.
Right.
That is a heavy cash burn.
Mm-hmm.
They're spending significantly more than they are making.
It is a heavy burn, but remember that fortress balance sheet we talked about at the top of the show?
Oh, the 3.1 billion.
Exactly. They have $3.1 billion in cash equivalents, and investments.
Let's do the math on that runway, actually. If you are burning roughly 100 million a quarter, that means you are burning 400 million a year.
Yep.
But you have 3.1 billion in the bank.
Right.
So theoretically, they have nearly 8 years of runway before they would even need to think about going back to the public markets or the debt markets to raise more capital, assuming the burn rate stays completely flat.
And that is the crux of the financial analysis for the headline numbers. If you are an investor, the equation is simple. Cash burn versus cash pile.
Simple as that.
The burn is high, but the pile is astronomical. They have the financial firepower to weather this incredibly capital-intensive development phase without diluting shareholders further.
Right.
They're aggressively spending on research and development to secure a technological monopoly. In fact, their R&D spend was $125.7 million for the quarter alone.
Wow.
That is up 215% year over year. Management noted on the call that their R&D budget alone exceeds the reported R&D of the entire rest of the pure-play quantum computing industry combined.
That is a staggering flex. I mean, they're basically trying to spend the rest of the industry into the ground.
They really are.
They are saying, we have a $3 billion war chest, and we are going to out-innovate, out-build, and out-patent every single startup trying to compete with us.
They're using their balance sheet as a weapon. And as long as that RPO, that backlog of guaranteed future money, keeps growing at over 500% year over year, the cash burn is deeply justified. It proves the R&D is translating directly into enterprise demand.
Makes sense. So they are burning $100 million a quarter, backed by a $3 billion war chest. But a war chest is useless if you aren't building a weapon. Where's that $100 million actually going?
That's the real question.
What are they physically building that convinces sovereign nations and Fortune 500 enterprises to hand over $500 million in guaranteed contracts? This brings us to the actual hardware and the story behind the numbers. Because the revenue mix tells a massive story about where this company is headed, and more importantly, how the underlying physics are evolving.
It really does. For a long time, Quantum computing was viewed strictly as an academic pursuit.
Yeah, just guys in lab coats.
Exactly. It was something government labs and university physics departments played with to run theoretical simulations. But the data from this Q1 quarter shows a definitive, aggressive shift toward real-world commercialization.
Okay, let's hit the specific data points from the call. First, 60% of their revenue is now classified as commercial.
Which is huge.
It is. That means the majority of their money is coming from private enterprises looking for a business edge, not just government grants or academic research facilities.
Right.
Second, 35% of their revenue is international. They are now actively selling in over 30 countries around the world compared to just a handful a year ago.
The global footprint is expanding fast.
Definitely. But the third metric is the one that really caught my eye, and it speaks to their long-term business model.
Ah, the multi-product sales.
Yes. Over 33% of their revenue now comes from multi-product sales. This is a brand new metric the CFO introduced, and it is a massive signal.
It really is.
It means a third of their customers aren't just buying access to a quantum computer. They are buying the computer, plus the networking capabilities to connect multiple computers, plus the quantum-resistant security software, plus the advanced sensing technology.
It is a classic land and expand strategy, but applied to next-generation physics.
Exactly. Think about it like buying a car. Usually you go to a dealership, you buy the car, and you leave. The dealership's relationship with you is mostly over.
Right.
What IonQ is doing is selling you the car, but they're also convincing you to buy the gas station to fuel it, the proprietary highway infrastructure to drive it on, and the GPS satellite network to navigate it. They aren't just selling a machine, they are selling an entire inescapable ecosystem.
That's a brilliant analogy, and that ecosystem approach is exactly why enterprises are willing to sign those massive multi-year contracts that drive the RPO numbers.
Yeah, the locks them in.
But to understand why these companies are buying in so heavily, we have to talk about the technology itself. We have to unpack why IonQ's specific approach to quantum computing is winning commercial contracts over massive legacy players like Google and IBM.
Right, because Google and IBM have endless money too.
Exactly. But IonQ has fundamentally shifted their hardware maturity. They are no longer just doing component-level testing. They are doing full system-level testing of their 236-qubit system, and they are already laying the groundwork and designing a 10,000-qubit system.
Okay, we need to pause here and do some translation. We hear the word qubit thrown around constantly in the financial media, usually without any context.
Too often.
Let's establish the baseline. A standard classical computer, the one you're listening to this on, the one routing global internet traffic, the supercomputers at NASA, they all use bits. A bit is binary. It is either a 1 or a 0, an on switch or an off switch. A quantum computer uses qubits. And thanks to the quantum mechanical property of superposition, a qubit can be a 1, a 0, or a complex probability of both 1 and 0 at the exact same time.
Right. And because they can exist in multiple states simultaneously, the computational power scales exponentially rather than linearly.
Okay, so it gets faster much quicker.
Exactly. Every time you add a perfect qubit, you double the processing power of the machine. But there is a massive catch that the industry has been struggling with for decades.
The error rate. Qubits are notoriously fragile.
Incredibly fragile. It's a concept called decoherence. If the temperature of the room changes by a fraction of a degree, if there's a tiny magnetic fluctuation, or even if a stray cosmic ray hits the processor.
I mean, cosmic ray, really?
Literally. If a cosmic ray hits it, the qubit loses its superposition state. It collapses. That is called an error. So to make a quantum computer actually useful for complex math, you cannot just rely on single physical qubits. You need what are called logical qubits.
Okay, and a logical qubit isn't a physical thing. It's a concept.
Yeah.
It is essentially a cluster of physical qubits working together using complex algorithms to constantly monitor and correct each other's errors, maintaining a single, stable, mathematically perfect state.
Exactly. So if a competitor company puts out a press release saying they have built a 1,000 qubit processor, that doesn't mean they have 1,000 useful logical qubits.
Well, that's misleading.
Very. In many competing architectures, the error rate is so high that they might need 1,000 physical qubits just to correct the errors and create one single stable logical qubit. That physical to logical ratio is the defining bottleneck of the entire quantum industry right now.
Which brings us to the great debate in quantum hardware. Superconducting versus trapped ion. Companies like Google and IBM use superconducting qubits.
Right.
From what I understand, they basically print artificial atoms onto silicon chips. similar to how traditional computer chips are made. But to keep those superconducting qubits stable, they have to put the chip at the bottom of a massive multi-million-dollar dilution refrigerator.
Which is an engineering nightmare. Seriously. They have to cool the processor down to a fraction of a degree above absolute zero, colder than deep space.
And even at those extreme temperatures, superconducting qubits suffer from a massive problem called crosstalk.
Crosstalk.
Yeah, because the qubits are physically wired together on a 2D plane on a silicon chip. When you try to manipulate one qubit, the electromagnetic noise accidentally affects the qubit sitting next to it.
Oh, wow.
It's like trying to have a private conversation in a crowded stadium where everyone has a megaphone. The interference is massive, which means the error rate is high, which means you need thousands upon thousands of physical qubits just to get one logical qubit.
And this is where IonQ's specific proprietary technology comes in and why they are winning these commercial contracts. IonQ does not use superconducting circuits. They use trapped ion qubits. Explain to us how trapped ion technology bypasses that crosstalk problem.
So instead of printing artificial atoms on a chip, IonQ uses actual naturally occurring atoms, specifically isotopes of ytterbium or barium.
These atoms are absolutely identical to each other in nature. They take these atoms, strip away an electron to give them a positive electrical charge, turning them into ions, and then they trap them in a complete vacuum using complex electromagnetic fields.
So they're literally levitating individual atoms in a vacuum.
Yes.
That sounds like science fiction.
I know, but it's real. And because the atoms are perfectly identical and isolated in a vacuum, the natural baseline fidelity, the stability, is incredibly high. They don't need to be cooled to absolute zero. The vacuum chamber is at room temperature.
Oh, that's a huge advantage.
Massive! But here is the most crucial advantage, and it solves the crosstalk problem you mentioned. To manipulate these trapped ions, IonQ uses highly precise lasers. They shine a laser at a specific atom to put it into superposition or entangle it.
And because they are using lasers in a 3D vacuum, rather than physical wires on a 2D chip, any single qubit can interact with any other qubit in the trap, regardless of where they are physically located.
Precisely. That is called all-to-all connectivity.
All-to-all connectivity. Okay.
In a superconducting chip, qubit A can only talk to qubit B if they are physically wired next to each other. If qubit A needs to talk to qubit Z on the other side of the chip, the information has to hop through 20 other qubits, creating massive noise and errors along the way.
That sounds incredibly inefficient.
It is. But in IonQ's trapped ion system, a laser simply couples qubit A and qubit Z directly. No middlemen, no crosstalk.
This brings us to a specific phrase management kept repeating on the call. Their blueprint for full fault tolerance, specifically mentioning the walking cat architecture.
Yes.
Now, I know the Schrodinger's cat metaphor is a cliche in quantum physics. You know, the idea of a cat in a box being simultaneously alive and dead until observed. But what is a walking cat in the context of IonQ's hardware?
Well, in quantum mechanics, a cat state refers to a specific type of quantum superposition, where a system is in a superposition of two macroscopically distinct states.
Okay, stay with me here.
When IonQ talks about a walking cat architecture, they are talking about a highly advanced error correction protocol uniquely suited for trapped ions. Because they have all-to-all connectivity and can physically shuttle ions around in the trap using electromagnetic fields, they don't have to rely on the incredibly inefficient surface codes that superconducting companies use.
Where surface codes require maybe 1,000 physical qubits to make one logical qubit.
Exactly. The walking cat architecture, leveraging the high baseline fidelity of trapped ions, drastically lowers the ratio of physical to logical qubits. They might only need 16 or 32 physical qubits to create a stable logical qubit.
That is a massive difference.
It changes everything. This means IonQ can reach utility scale, the point where the computer actually starts solving impossible problems that classical computers cannot solve much faster, and with a much smaller, more energy-efficient physical footprint.
And we are already seeing enterprises use this specific trapped ion tech for mind-blowing, real-world applications. The earnings call highlighted 4 specific commercial partnerships that prove this isn't theoretical physics anymore. This is applied, commercial physics. Let's run through them, because this is where the theoretical rubber meets the financial road.
Let's do it. Let's start with the financial sector. The call highlighted their work with a company called Quantum to run the world's first large-scale portfolio optimization algorithm using actual real-world S&P 500 data.
Let's break down why this requires a quantum computer. If you are a massive hedge fund trying to build a mathematically perfect portfolio across the S&P 500, you have 500 variables.
Right.
But you also have to factor in how each of those 500 stocks correlates with the other 499 stocks. If Apple goes up, how does that affect Exxon? If interest rates rise, how does that affect both of them concurrently? The number of possible combinations and correlations is astronomically large.
It creates what mathematicians call a combinatorial explosion. If you ask a classical supercomputer to find the absolute mathematically optimal portfolio balancing risk and return across all those variables, it has to evaluate the probabilities sequentially. It checks combination A, then combination B, then combination C. It takes an immense amount of time.
But the quantum computer, using superposition, essentially evaluates the massive probability space concurrently.
Yes, it maps the variables onto the qubits, and the physics of quantum interference naturally cancel out the suboptimal portfolios and amplify the probability of the optimal portfolio.
That is wild.
And because IonQ's hardware has that all-to-all connectivity we discussed, it is uniquely suited for dense, heavily correlated optimization problems like financial modeling, where every variable impacts every other variable.
That is finance. What about heavy manufacturing? The call explicitly mentioned a partnership with Synopsys.
Synopsys is an absolute titan in the electronic design, automation, and computer-aided engineering space. They are using IonQ's systems for something called quantum-enhanced graph partitioning.
Okay, what does that mean in plain English?
They are running structural models on incredibly complex mechanical systems, specifically mentioning a Rolls-Royce jet engine and advanced automotive models.
Ah, if you are an engineer designing a next-generation jet engine, there are millions of microscopic stress points, airflow variables, temperature tolerances, and material physics to consider. Simulating how all those parts interact in real time under extreme stress is a computational nightmare.
It's nearly impossible.
It can take days or weeks for classical supercomputers to run a single high-fidelity simulation. But IonQ delivered a double-digit percentage advantage in the end-to-end time it takes to run these massive structural models. And the kicker, they integrated this computational boost directly into Synopsys' existing cloud workflow.
That's the most important part.
The end customer, the engineer designing the jet engine, didn't have to learn quantum physics or build new infrastructure. They just hit simulate in their normal software interface, and IonQ's hardware accelerated the math in the background.
It is that seamless API-driven integration that is driving immediate commercial adoption. The customer just wants the answer faster. They don't care that trapped atoms are doing the math.
Exactly. They just want the engine to not explode.
Right. Moving on to global logistics, they highlighted a major partnership with Einride. Einride operates massive electric and autonomous freight fleets. They are using the quantum computer to optimize shipment allocations and fleet orchestration.
This is the classic, mathematically infamous traveling salesperson problem brought to life. If you have 5 delivery stops, there are 120 possible routes. A standard computer can calculate the fastest one instantly, but if you have 15 stops, there are over 1 trillion possible routes.
And it just scales exponentially from there.
Now imagine Einride. They have thousands of autonomous trucks, tens of thousands of delivery points, constantly changing traffic patterns, varying battery charge levels, and shifting weather systems. How do you route them perfectly to minimize energy use and maximize delivery speed?
A classical computer literally cannot solve it perfectly. It has to use heuristics and educated guesses to find a good enough route, because checking every possible combination would take longer than the age of the universe.
Wow.
The quantum computer, again, maps the entire logistical network as an energy landscape, using quantum tunneling to find the absolute lowest valley, which represents the mathematically optimal route, almost instantly.
That is incredible.
IonQ reported that they are already demonstrating real-world commercial validation using anonymized logistics data, resulting in a measurable, immediate increase in shipments delivered on time. At global fleet scale, a 1% optimization in routing translates to hundreds of millions of dollars in fuel savings and revenue gains.
And finally, they highlighted the healthcare and biotechnology sector, which might be the most consequential application of all. They're working with the Welcome Leap Initiative and the CCRM Accelerator.
Right.
They are applying quantum optimization to reconstruct highly difficult, repetitive regions of human DNA that standard sequencing methods miss. Furthermore, they are optimizing mRNA sequences that get delivered directly into cells for advanced cancer research and immune system rebuilding.
The complexity of simulating biological molecules is immense. A classical computer struggles to accurately simulate even a simple caffeine molecule because it cannot properly track the quantum mechanical interactions of every single electron orbiting the molecule.
Just caffeine.
Just caffeine. But a quantum computer operates using the exact same quantum mechanics that govern the molecules themselves. As the famous physicist Richard Feynman originally proposed, if you want to simulate nature, you need a quantum machine.
Makes perfect sense.
IonQ is moving beyond solving traffic jams. They are attempting to simulate the fundamental building blocks of human biology at the molecular level to accelerate personalized, targeted medicine.
When you hear these use cases thoroughly unpacked, S&P 500 modeling, Rolls-Royce jet engines, autonomous global fleets, and mRNA cancer sequencing, it becomes incredibly clear why that RPO backlog is growing by 554% year over year. Enterprises aren't buying into the hype. They are realizing that if their direct competitor gets access to this computational power first, they are going to be mathematically left in the dust.
It is a corporate arms race.
It is an arms race.
Yeah.
And to fuel that arms race and to secure their position as the dominant arms dealer, IonQ made a massive strategic move this quarter that requires some deeper analysis. They discussed the impending acquisition of a company called Skywater, which is a semiconductor fabrication facility. The acquisition is expected to close in the second or third quarter of 2026.
Yeah, let's focus on this because this isn't just a standard vertical integration play. It isn't just about IonQ owning the factory that makes the photonic chips and the traps for their own computers to save on manufacturing costs.
Right. It's much bigger than that.
It is a much bigger, much more aggressive geopolitical and economic play. The CEO explicitly stated on the earnings call that acquiring Skywater turns IonQ into the world's largest merchant supplier for the entire U.S. and allied quantum market.
Let's translate merchant supplier. In a gold rush, the people who make the most reliable, generation-spanning wealth aren't the prospectors digging for gold. It is the people selling the picks, the shovels, the wheelbarrows, and the denim jeans.
Exactly.
By acquiring Skywater, IonQ is positioning themselves to manufacture and sell the foundational hardware, the specialized photonic chips, the atomic clocks, the advanced sensors, to their own direct competitors.
It is the TSMC model. Taiwan Semiconductor Manufacturing Company doesn't make consumer cell phones or graphic cards. They make the silicon chips that go into everyone else's products, from Apple iPhones to NVIDIA AI processors.
Right, they own the bottleneck.
TSMC is the undisputed bottleneck of the classical computing world. IonQ wants to be the TSMC of the quantum age. They want to use their massive $3.1 billion balance sheet to secure the manufacturing scalability of the entire industry.
That is a brilliant strategic hedge for investors. If IonQ wins the compute race and builds the best quantum computer, you win as an investor.
Obviously.
But if a competitor somehow builds a better compute architecture, but they are forced to use photonic components manufactured by IonQ's Skywater facility because it's the only domestic foundry capable of producing them at scale, you still win. They are indexing themselves to the success of the entire sector.
It's very smart. And this transition from a bespoke hardware developer into a merchant supplier and ecosystem provider seamlessly brings us to Section 3 of our deep dive, management guidance and the looming shadow of Q-Day.
Ooh, Q-Day.
With a clear picture of how they are commercializing the technology across industries, we have to look at what management is explicitly promising for the rest of the year and what macroeconomic forces are driving it.
The forward guidance numbers present a really interesting puzzle that analysts immediately jumped on. Management raised their full year 2026 revenue guidance. They are now projecting between $260 million and $270 million for the year.
Which is great.
That represents 100% organic year-over-year growth.
Yeah.
Fantastic. However, they set their specific Q2 guidance at $65 million to $68 million.
Which naturally raises some eyebrows if you extrapolate the math.
Right. Let's do the math. If Q1 delivered $64.7 million, and Q2 is guided for a maximum of $68 million, that implies sequential quarter-over-quarter growth is essentially going flat. If they do $65 million a quarter for the rest of the year, they hit their $260 million target, but it means their growth curve is flattening out.
It looks concerning on the surface.
As an investor, you have to ask, are they hitting a demand wall? Is the market for enterprise quantum computers tapping out?
It is a vital question, and to answer it, we have to look closely at the synthesis from the Q&A portion of the earnings call. Institutional analysts pressed management on this exact mathematical discrepancy.
And what did they say?
Management's response was definitive. They are actually supply constrained, not demand constrained.
So they have the buyers lined up. which is reflected in that massive 475 million RPO backlog, but they physically cannot build and install the machines fast enough.
Exactly. The chief operating officer noted that near-term demand for their enterprise compute products was vastly outpacing their physical ability to fulfill it. Building a commercial quantum computer isn't an automated assembly line yet.
Right. You can't just stamp these out.
It requires bespoke engineering, specialized photonics, and highly trained physicists. To fix this bottleneck, they are aggressively hiring deployment engineers and expanding their field operations globally. Most notably, they have more than doubled their manufacturing floor capacity in their Seattle facility for their fifth-generation systems, which they call the Tempo architecture, just to keep up with the current backlog.
So the relatively flat quarter-over-quarter guidance isn't a lack of sales momentum. It is management exercising what they explicitly call prudence.
Right.
They don't want to promise revenue on the income statement that they can't physically deploy and recognize in the quarter. They're artificially tempering short-term expectations while they spin up the Skywater manufacturing lines.
And the reason demand is spiking so aggressively, outstripping their ability to build, brings us to the most urgent and, frankly, the most terrifying catalyst discussed on the entire earnings call.
Here we go.
It is an event the cybersecurity and intelligence industries refer to as Q-Day.
Okay, we need to spend serious time unpacking Q-Day because this sounds straight out of a geopolitical cyber thriller, but it is driving hundreds of millions of dollars in enterprise sales today. What exactly is Q-Day?
Q-Day is the theoretical date when quantum computers become powerful enough and possess enough stable logical qubits to successfully run Shor's algorithm at a scale that breaks traditional RSA 2048 encryption.
Let's break that down for the listener because the mechanics here are crucial. RSA 2048 is the cryptographic standard that protects basically everything in the modern digital world.
Literally everything.
It protects your bank transfers, your secure text messages, corporate trade secrets, national power grids, and highly classified military communications.
The security of RSA encryption relies on a very specific mathematical problem: prime factorization. It is incredibly easy to multiply two large prime numbers together to get a massive number. But if you are given that massive number and asked to figure out which two prime numbers were multiplied to create it, it is incredibly difficult.
It's the lock and key analogy, right? Multiplying 17 by 19 to get 323 is easy. But if I give you the number 323 and say find the factors, you have to guess and check.
Yes.
Now imagine that number isn't 323, but a number with 600 digits. A classical supercomputer has to try every single possible combination sequentially. It acts like a burglar trying millions of keys on a padlock one at a time. It would take a classical supercomputer millions of years to crack a single RSA 2048 encryption key.
Exactly. The encryption is secure purely because classical computers are too slow. But in 1994, a mathematician named Peter Shor developed Shor's algorithm specifically for quantum computers. Shor's algorithm doesn't guess and check sequentially. It uses quantum superposition to map the factorization problem into a complex wave function, a period-finding problem. Through quantum interference, the wrong answers destructively interfere and cancel each other out, while the right answer constructively interferes and amplifies itself.
So instead of trying millions of keys one by one, the quantum computer effectively tries every key simultaneously, and the laws of quantum physics cause the correct key to physically glow in the dark.
That is a brilliant way to visualize it. A sufficiently powerful quantum computer running Shor's algorithm could crack RSA 2048 not in millions of years, but in hours or minutes.
That's terrifying.
It is the ultimate digital skeleton key. It renders modern cybersecurity obsolete instantly. And for years, the industry consensus was that Q-Day was decades away. Cryptographers thought it might happen in the mid to late 2030s or even the 2040s. It was viewed as a problem for the next generation of IT professionals to worry about.
But the timeline is radically compressed, which is why the panic buying has started.
It has compressed violently. On the call, the CEO noted that Google very recently pulled their internal expectation for Q-Day forward to 2029.
2029.
Yes. IonQ's own published hardware roadmap predicts they will achieve the specific logical qubit counts required to challenge RSA encryption in the 2028 to 2029 window. Furthermore, intelligence reports indicate that state-sponsored quantum efforts in China are specifically targeting 2029 to achieve this capability as well.
2028 is only 2 years away.
Huh?
If you are the chief information security officer for JPMorgan Chase, or the Secretary of Defense, and you find out that the encryption protecting the global financial system and nuclear launch codes is going to be fundamentally obsolete in 24 to 36 months, you hit the panic button.
You don't have a choice.
You don't wait until 2028 to upgrade. You have to upgrade your infrastructure today.
Furthermore, they have to worry about store now, decrypt later attacks.
Oh, what is that?
Hostile intelligence agencies are currently harvesting massive amounts of encrypted data, everything from diplomatic cables to proprietary corporate research, and just storing it on massive hard drives. They can't read it today.
It's encrypted.
Right. But the moment they have a quantum computer capable of running Shore's algorithm, they can decrypt all of that historical data retroactively.
And that sheer existential panic is the ultimate sales driver for IonQ's business right now. It is driving massive urgent sales in their security and networking product lines. They aren't just selling computers, they're selling the solution to the exact problem they're creating.
It is the ultimate dual-use technology. The call highlighted several specific examples of this sovereign panic buying. For instance, IonQ successfully deployed Poland's first national quantum communications network.
Holy, Poland?
Yes, it is one of the largest terrestrial quantum key distribution networks in Europe, designed specifically to secure Polish government communications against future quantum decryption.
They also announced a massive new statewide quantum network in the U.S., hosted at the University of Maryland, and a strategic partnership with the Florida Lambda Rail.
The Florida Lambda Rail contract is particularly revealing regarding the urgency of this transition. The Lambda Rail is Florida's high-speed research and education network. The IonQ contract is a phased rollout, starting with a limited geography to test quantum key distribution. But the explicit goal stated on the call is to expand it to a statewide initiative protecting critical civic infrastructure, power grids, water treatment plants, emergency response networks. State governments are realizing they have to lock down their crown jewels immediately before Q Day arrives.
What's fascinating here is the sheer audacity of the business model. IonQ is building the weapon that threatens global cybersecurity and simultaneously selling the shield. The CEO actually described it as a strategic flywheel. Because IonQ is leading the hardware race, their engineers know exactly how the advanced systems will behave and how they will break encryption. That proprietary, inside knowledge allows them to build superior quantum-resistant defenses and networking protocols to sell back to their enterprise and government customers. It is a brilliant, almost ruthlessly efficient capitalist model.
It creates a totally captive market. If you want to survive Q-Day and protect your data, you realistically need to buy the quantum security protocols from the people who are building the premier quantum code breakers.
It's kind of genius.
It really is. And this dynamic seamlessly leads us to Section 4, the bottom line. We have seen the incredible headline numbers and the $3 billion balance sheet. We understand the physical advantages of trapped ion tech and the multi-product commercial ecosystem.
Right.
We have looked at the supply constraints, the TSMC manufacturing model, and the massive macroeconomic catalyst of Q-Day. Now it is time to take a position. What does all of this mean for your portfolio? Are we fundamentally bullish or bearish?
Let's start with the bear case, because there is one specific piece of data from the earnings call that gives bears a massive amount of ammunition, and we cannot ignore it.
We can't.
During the Q&A session, a prominent analyst pointed out that IonQ's gross margins were down roughly 1,600 basis points quarter over quarter. That is a 16% drop in gross margin profitability in a single 3-month period.
It is a massive red flag in standard fundamental financial analysis.
Right. If Apple or Microsoft reported a 1,600 basis point drop in gross margins, their stock would plummet 20% the next day. It usually means your manufacturing supply chain costs have spiraled wildly out of control, or you're desperately slashing prices and taking a loss just to win contracts and artificially inflate your revenue growth.
Exactly.
But management essentially brushed it off. The CFO told investors point blank to focus on EBITDA and R&D instead of the cost of goods sold, or COGS. His exact quote was essentially, "I would not obsess over the gross margin right now."
He argued that they have a distinct long-term structural advantage because of their underlying technology. As we discussed earlier, they use trapped ion tech. The CFO pointed out that the bill of materials, the actual cost of the physical parts required to build a trapped ion computer, is a fraction of the cost of competing superconducting technologies.
Okay.
They don't need to source massive, highly specialized, energy-hungry dilution refrigerators that IBM and Google rely on. Their systems run at room temperature, use standard vacuum technology, and have significantly lower ongoing energy requirement.
Okay, but a 16% drop is a 16% drop.
The CFO's argument is that because their fundamental baseline manufacturing costs are so low, the wild gross margin fluctuations we are seeing right now are just temporary noise based on what specific product mix they happen to recognize in a given quarter.
Ah, the mix.
Right. If they recognize a massive high-margin software contract one quarter, margin spike. If they recognize the delivery of a physical, hardware-heavy system the next quarter, margins drop. The unit economics haven't normalized because the manufacturing process is still being actively invented.
Look, I have to push back on this. I understand the product mix argument. But as an investor, it is always a massive blaring red flag when a management team looks you in the eye and tells you to ignore gross margins.
It is risky, I agree.
It is the classic pay no attention to the man behind the curtain maneuver. A 16% drop in gross margin in a single quarter is a disaster in any other sector. I can't just give them a free pass because they have a bunch of cash.
Well,
Cash runs out eventually if the fundamental unit economics of building these machines are broken. If it costs them $20 million to build a machine they sell for $15 million, they will eventually go bankrupt, regardless of the $3 billion war chest.
you would be absolutely right if they were mass manufacturing iPhones or selling standardized enterprise software. But they aren't. They are building bespoke quantum hardware at the very bleeding edge of human physics. The unit economics haven't normalized because they are currently transitioning from being an R&D lab into a commercial manufacturer.
True, it is a messy transition.
That transition is historically messy. And this is exactly why the Skywater acquisition is the linchpin to the entire thesis. Once they own the foundry and bring the photonic chip manufacturing in-house, they control their own supply chain. The gross margins will stabilize once they achieve merchant supplier scale.
Okay, I will concede the point on scale. When a company has $3.1 billion in cash sitting in the bank, and they are aggressively trying to build a global TSMC-style monopoly on a completely new form of physics, you give them a wider berth.
You have to.
You allow them to burn cash and suffer short-term margin volatility to secure dominant, inescapable market share in the long term.
I completely agree. And my verdict is definitively bullish for the long-term patient investor. The math ultimately supports the thesis. You have a massive multi-year cash runway that virtually eliminates near-term bankruptcy or dilution risk.
Which is huge.
You have 100% organic year-over-year revenue growth. You have the ultimate macroeconomic tailwind in the form of key date panic. But the real reason for the bullish stance is the App Store ecosystem approach we discussed earlier.
The 33% multi-product sales.
Exactly. They aren't just selling a box. They are selling the compute power, plus the networking infrastructure to connect them, plus the advanced sensing technology, plus the quantum-resistant security protocols.
The full package.
Once a sovereign government or a massive Fortune 500 enterprise deeply integrates IonQ's hardware, software, and security protocols into their daily operations to route their trucks or secure their data, the switching costs become astronomically high. It is incredibly sticky revenue. They are not just building a product, they are becoming a category leader with a deeply entrenched foundational ecosystem.
So let's give the listener the actionable takeaway. If you are currently holding this stock, or if you're looking to start a position based on this analysis, what do you do?
Good question.
The action plan is to ignore the quarter-to-quarter gross margin noise for the next 12 to 18 months, as painful as that might be for traditional value investors. Instead, watch two specific things like a hawk. First, watch the RPO, that backlog metric.
Yes, absolutely.
If that guaranteed future revenue keeps growing at 300%, 400%, or 500% year over year, it proves the sales team is executing, enterprise demand is real, and the heavy R&D cash burn is deeply justified.
Exactly right.
Second, watch the Skywater acquisition closely. If that deal closes successfully and they begin aggressively ramping up as a merchant supplier to the rest of the industry, that legally cements their monopoly position.
That is the exact right framework. Keep your eyes on the backlog growth and the manufacturing scale-up. Everything else, including the Jap net income mirage and the short-term margin compression, is secondary noise right now.
Which brings us to the outro. To summarize this massive deep dive, IonQ is no longer a science experiment confined to a university basement. They are a rapidly maturing commercial entity experiencing explosive triple-digit growth backed by an invincible $3 billion balance sheet and driven by the urgent existential threat of Q-Day.
Very well summarized.
They aren't just selling computers. They're trying to become the foundational infrastructure for the entire quantum age.
And that infrastructure ambition, becoming the backbone of the next era of computing, leads to a fascinating and somewhat sobering broader context that goes beyond finance.
Yes, we wanted to leave you with one final provocative thought to mull over because it fundamentally changes the risk profile of the company. Tucked away at the very end of the earnings call, management casually mentioned that they currently have advanced quantum sensors physically deployed on United States Navy ships and in low Earth orbit on the X-37B spaceplane.
For context, the X-37B is the United States military's highly classified unmanned orbital test vehicle. It is the bleeding edge of the defense apparatus.
Right. They are actively securing deep, classified Department of Defense contracts for next-generation GPS alternatives, secure satellite communications, and national defense encryption.
It's serious business.
So here's the question for you to consider as an investor. If IonQ's technology truly becomes the irreplaceable backbone for the nation's most sensitive military communications, power grid security, and core defense apparatus against foreign quantum cyber attacks, does this company eventually become too critical to national security to operate as a normal, publicly traded entity?
It immediately raises the specter of government intervention. Could a technology this powerful and this vital to national survival in a post-Q-Day world be allowed to trade freely on the open market forever?
It's a scary thought.
Could it be acquired by a foreign entity? Or will the government invoke national security protocols to restrict its public ownership, limit its commercial sales, or even nationalize the technology entirely? It is a question that goes far beyond financial metrics and cuts to the absolute core of 21st century geopolitics.
It is the ultimate risk for the ultimate technology. Something to keep in mind as we watch that Schrodinger's balance sheet collapse into a very real, very powerful reality over the next few years. Thank you for joining us on this Talk Tickers Deep Dive. As always, keep reading the 10 Qs, keep demanding the real operating numbers, and keep questioning the numbers behind the narratives. We'll catch you on the next one.